Welcome to the 3 Edge Weekend Review for the week of October 30th. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3Edge Asset Management. And it's certainly a truism that investing comes down to making decisions under conditions of uncertainty, and this week Steve and I will be discussing how to invest in a market where uncertainty seems to be particularly elevated and the way forward for the economy and the market seems particularly unclear. Before we get to that, a brief recap of this week. And both stock and bond markets got a boost. In the middle of the week, we had the Fed make its announcement that it would not raise short-term interest rates. The announcement itself wasn't a surprise. The overwhelming majority of folks on Wall Street expected the Fed to pause and not raise rates at the meeting. However, as is often the case, it was Chair Powell's press conference that made headlines. Investors interpreted Powell's remarks to be on the dovish side, whether he intended them to be or not. Then, on Friday, the bond market got another lift when the Bureau of Labor Statistics issued its report for jobs for October and showed that hiring in the U.S. had slowed more than expected last month. Bond investors interpreted this report as an indication that the U.S. labor market is finally beginning to soften, which is something that the Fed is watching closely. In addition, Friday's jobs report also showed the unemployment rate climbed to an almost two-year high, reaching 3.9% in October. However, that's still historically a very, very low level of unemployment. So we experienced this past week, we had bond yields declining, equities moving higher. Maybe it's just a bounce after a 10% correction in the S&P. Another case of investors' fear of missing out on a potential rally if the Fed is actually signaling an end to its tightening cycle. However, somewhat ironically, it is more likely that the Fed would pivot only if the S&P and other risk assets would drop further from here. And it's still the case that the cumulative effects of tightening have not really impacted the real economy yet. Also, lastly, in corporate earnings news, Apple reported its sales declined for a fourth straight quarter, and that's the longest period of falling sales for the company since 2001. So let me bring Steve in here now. And Steve, as we well know, what makes investing challenging is that you're always making decisions under conditions of uncertainty. But it does seem that we're in an environment where the level of uncertainty facing investors is higher than normal. And there seem to be a variety of directions that this market and economy could go from here. So maybe if you could just point out what it is about the current environment that makes it so much more uncertain.
Well, Fritz, I think the idea of radical uncertainty reflects the unusually wide gap between optimistic and pessimistic scenarios across the global capital markets. For instance, now we have multiple conflicts in Israel, in Ukraine, in Taiwan. The optimists are hoping that they stay contained and start to get a little bit easier. But the pessimists are very worried about the risk of a wider war, and even the words World War III have been bandied about. Huge difference between one and the other scenario, with major implications to the markets. Regarding the economy, the optimists are saying we're in a Goldilocks economy. It's not growing so fast that the Fed has to keep hiking rates. It's not growing so slow that we have to worry about a recession. It's just right. There's talk about an immaculate disinflation where inflation comes down on its own without any more rate hikes, and we have sustained growth. Corporate profits continue to rise, not fall, and we have a bull market. Now, on the other side, no, we're headed into a recession, and the tick up in unemployment we just saw on Friday is evidence of the early stage of that. And that maybe we get inflation along with that. So the worst case is stagflation, and that would certainly lead to a bear market. And then we have seen extreme interest rate volatility, the most extreme interest rate volatility in history, actually. For some time, we've seen the bond market in the steepest route historically. We've never seen the bond market fall so steeply, meaning interest rates going higher. in the long duration bonds. And then just this week, as you mentioned, we have a snapback where now rates are falling more steeply than we typically see. So all this tremendous wide gap between the optimistic and the pessimistic scenarios, I think reflects this idea that we're in a time of radical uncertainty.
Absolutely. So, as we know, there has been a good amount of discussion among investors who believe that, in spite of this week's rally in stocks and bonds, being invested right now feels risky. And since short-term instruments such as money market funds and bank CDs are now paying a higher yield, why shouldn't investors just go to cash now, buy a bank CD, or put their money in a money fund, wait this period of extreme uncertainty out, and then get back in the market when the time is right?
Well, for now, cash is yielding more than the inflation rate. So there are certain money funds, not all of them. There are certain CDs, not all of them. And certainly there are instruments in certain brokerage firms and banks that still have very paltry interest yield. But for the most part, most of the CDs and money funds are yielding more than inflation. So for right now, that seems like a decent deal. However, longer term, CDs and cash do a terrible job at keeping up with inflation. And typically after taxes, it's rare that you can keep up with inflation just by investing in CDs and money markets. Now, CDs are an effective hedge against the potential of a credit contraction. And we've talked about a risk of credit contraction. And we do own more short-term treasuries than we normally would hold. And I think that's a logical thing. However, it would be a big mistake to have all of one's money in that, and especially in CDs when you're locking it up, because there are many more conditions that we talked about, risky conditions where CDs or cash are not the most effective hedge. For instance, if the war scenarios get uglier and we have more geopolitical uncertainty, well, gold will be a much better hedge, and real assets will be a much better hedge than cash. If we get into stagflation, where we have a slowing economy and persistent inflation, then TIPS, or Treasury Inflation Protected Securities, would be a much better hedge than cash or CDs. If it turns out that we go into a recession without inflation, then longer term bonds will be a much better hedge than CDs or cash. And if it turns out that the optimistic scenarios I mentioned come to pass, then having some equities will go a long way toward giving you a decent return over and above inflation, and not cash. And then finally, once you go into CDs or cash, you now have the decision to make when to get out. And history shows that most people don't get out at the right time. And so for all those reasons, I think it's a mistake to put all of one's money in any one asset class, even if it's CDs or cash.
That's perfect segue into my third and final question, which, as always, is based on what we've discussed today about much greater levels of uncertainty in the market. How, in fact, should investors think about positioning or adjusting their portfolios in this environment?
So, especially under a time of radical uncertainty, I think it's a common investor mistake to be overly confident that they can guess which of all these different scenarios is going to come to pass, and then bet all of their investment funds on that one scenario. And even cash would be an example of that, where you're betting that everything's going to be in a credit contraction, everything's going down, and that it's the only one investment that makes sense, which is being overly confident about a certain scenario. And especially if you lock into a CD, we know that typically CDs lock you in for several months, depending on what maturity you get. And boy, when the conditions change, I've seen holders of CDs just chomping at the bit, wishing they weren't locked in, waiting for the maturity date to come. Otherwise, they get a penalty. And I've seen a lot of discomfort in that scenario. So going over the asset classes, taking equities first. Our model research shows that there are some undervalued attractive equity indices right now. Right now, we're looking at Japan, and we're looking at certain emerging markets as being particularly undervalued, especially relative to the US, quite attractive with more accommodative monetary policies going on. And we do have investment in those equities, but we want to moderate it because there's still a potential threat of the US market, which we measure as highly overvalued, entering a more prolonged bear market correction. And if it's steep, it could drag all the markets down with it, even the undervalued equities. So we don't want to put all of our assets into those few equities that we think are undervalued. We want to be careful because the entire global equity market could come down. But we don't want to be at 0% equities either. That would be radical. Next, if we talk about the geopolitical uncertainty, we all hope for peace, obviously. We all hope for these conflicts to get contained and then get settled. But we know from history that there's a risk of conflicts spreading and evolving into wider wars, and it can happen by accident. Just like World War I was kind of accidental, how the world stumbled into World War I. So we certainly want to have some real assets that would hedge against that. And real assets can include gold, and sometimes they can include commodities. If the Straits of Hormuz get shut down by Iran, oil prices will spike, global trade will slow down. There'll be a lot of problems. So we do want to own some real assets. And then finally, on the fixed income side, we do favor shorter duration treasuries. And that's been exactly the right place to be versus longer duration bonds, which have really lost a lot of principal depreciation as interest rates have climbed. But there is some sense that maybe the Fed is at a pivot point. And if inflation happens to come down more than expected, then the long-term bonds might start to behave in a better way. However, we suspect that there's still a strong chance that inflation is very persistent, that it's sticky, and that bond investors might be getting a nice bounce here, but might be disappointed. So we have some minimum allocation to longer duration bonds for that situation, that possibility that we have a more benign inflation and we get a recession. But we'll stay at our minimum because of the risk of stagflation. So the big point here is under a period of radical uncertainty, what that should mean is, as an investor, it's the time to be diversified, not to be a hero and put all your chips on one outcome.
Excellent. Very sensible advice. Thank you for your insight. And it does certainly seem like there is a great deal of uncertainty out there that investors are facing. So that will do it for Steve and me for this week. Eric Beagleisen and I will be back next week with our monthly View from the Edge for November, where we provide our firm's most recent outlook, which is based on our proprietary research model. As a reminder, our entire library of short videos always available on our 3Edge YouTube channel. And if you think that someone you know might enjoy and benefit from our weekly videos, please feel free to share them by sending them the YouTube link. So that will do it from here. On behalf of Steve and everyone at 3Edge, we wish everyone a wonderful weekend, and thanks for listening.